Hello and welcome to Portfolio Perspectives with me, Tom Santa-Olalla. Now, markets have been a little bit volatile over the course of the year so far, but one area of portfolios that has seen some relative calm but still producing some positive returns have been alternatives. And so I thought it'd be useful to take a dive into that asset class to understand a little bit more about what they are, why they're important, and how we're positioning them in portfolios in today's environment. And to help me on that, we're going to be talking to Alastair Baker, one of our portfolio managers. Alastair, welcome.
Thank you for having me.
So let's start at the beginning. What exactly are alternatives?
We keep it very simple. An alternative is an asset class that isn't global equities or traditional bonds. What we're trying to do is get exposure to something we can't get in those asset classes, and we're hoping that gives us an exposure that performs slightly differently at different times in the investment cycle and also generates good returns.
A very, very broad definition you've given me there. Can we bring that in a little bit? Are there any characteristics you're looking for?
Yeah, it's really important to bucket alternatives into the role they play within the portfolio. We have alternative equity, where we're accessing a variety of different private equity strategies. We have alternative income, where we're owning a whole range of income-producing assets, from infrastructure projects to specialist biomedical lenders. We have absolute return, where we're trying to extract returns from the financial market in a different way, normally through a degree of arbitrage. And we have gold.
Okay, well, given that it's such a broad asset class, there's no one way of or a single means of assessing its performance. So I think it's easiest to look at our portfolios themselves and how we've been allocating to alternatives. How's that performed over the time frame that we've been using them?
It's something that we're proud of. If we take the Saracens Endowment Fund, we have a 19-year period we can assess ourselves over. And over that period, what we've seen is returns of just under 8% per annum from our alternatives portfolio, which compares with global equities, which were just a little over 9%, and quite a long way ahead of poor old UK government bonds, which have delivered just over 2%. But importantly as well, we see a reduction in volatility compared to equities, about 40% lower, and only a little bit higher than government bonds. What that really means is we have an asset class that performs slightly differently within the portfolio, does so with some quite nice risk and return characteristics. It's a really nice asset to hold within a multi-asset portfolio, and particularly has helped the portfolio as predominantly we've funded the allocation strategically out of government bonds.
Okay, but those returns, they're not going to be linear, of course. You're going to have good times and bad times. 2023 was a bit of a challenging year for alternatives. Can you talk me through that?
Yes, I think that you need to set 23 though in the context of 2022. 2022, we had equity markets down significantly, bond markets down significantly, and the alternatives portfolio delivered a moderate positive return of around 4%. We saw a reversal of that in 2023. We saw equity markets recover strongly, bond markets recover a little bit, and our alternatives portfolio deliver a moderate loss of around 4%. So what we're seeing there is the benefit of alternatives in helping to smooth the path of return by giving a different return profile from equities and bonds. But it's quite disappointing not to be delivering strong returns, because while the wiggliness of the portfolio's line is important over the short term, in the long term what really matters to our clients is ensuring that we deliver inflation, which means we need alternatives to deliver those strong returns.
And in today's market regime, where we do expect higher inflation levels, how are you positioning our alternatives?
I think we think of the current market regime as one where we will see higher inflation and continue to see stretched government balance sheets. And what that's going to do is put pressure on asset classes which have long-term fixed cash flows and also probably fiat currencies. And what that means is we've moved away from things like alternative income and towards assets like gold.
Which of course has been a very strong performer over the course of the last couple of years. So it's heartening to see that alternatives are back to fulfilling their role within portfolios. They've had a strong 2024, a very strong 2025 so far, but crucially they provided that ballast in portfolios when markets were a little bit bumpy back when tariffs were first announced at the earlier stages of the year.
Yeah, and I think we've given examples that, it's not a panacea alternatives, but it's a really helpful tool in our investment toolkit, particularly within multi-asset portfolios.
So we touched on gold very briefly. Dare I ask about digital gold, as some people refer to it? Do we have a view on Bitcoin or sort of digital currencies?
So we are of the opinion that real assets will perform in this environment. What do I mean by that? Is those that have a store of value. Generally, those things that have a store of value have a finite supply in some sense. And Bitcoin does fall into that category. It's an asset class that we've been looking at carefully since 2019, and it has, gradually been maturing. But what we also have to say is, look, in theory, it's going to behave like gold. You could see it's still very sentiment driven, it's very volatile, but it does therefore have the potential also to deliver maybe stronger performance. So it's certainly well within the conversation given the current regime we're operating within.
And another area that has been generating a lot of coverage in financial media, at least, is private markets. So what's our view in that space?
So we continue to think that companies that can grow their earnings faster than inflation because they have strong pricing power will do well in this market environment. Having access to private markets allows us to cast our net much, much wider.
And the quid pro quo, of course, is illiquidity. So you're giving up a little bit of liquidity on the hope of future stronger returns.
Yes, that's correct, but it is something that we can manage. We have a number of different ways of investing in private markets, through listed vehicles, through semi-liquid vehicles, and also taking on that fuller liquidity risk. But clearly that is a conversation we have to have with our clients about what they can tolerate within their own individual portfolios. Thankfully, we have the capability to do that with our Bread Street team, so it's an asset class we like and a capability we have within Saracen & Partners.
Alastair, that's been a really helpful introduction to alternatives, covering everything from private equity to gold and all sorts in between. They've all got their role to play within portfolios, bringing that extra diversification and other streams of risk and return. So thank you for your time, much appreciated.
A pleasure.
And thank you for watching. In this video, we've only just scratched the surface of alternatives. So if you would like any further information, please do reach out to your investment manager. And of course, if you're interested in our views on the current market, please look out for Guy Munson's 6-Minute Strategy. Thank you very much.